Let's talk about one of the most popular ones, which is the no tax on tips. Could you explain this?
Yeah. So we were going back and forth around, are we going to have no taxes on tips? Are we going to have no taxes on overtime? And what we settled on is we get to deduct up to $25,000 of tips. So if you're receiving tipped income, like a lot of people do here in Las Vegas, you get to deduct up to $25,000 on your federal tax return, not on your state tax return. And it doesn't include payroll taxes, but that's a $25,000 deduction. The only issue is, it's only if your adjusted gross income is $150,000 or less. It phases out after that $150,000 if you're single, $300,000 if you're married filing joint. But when you look around the United States, I don't know if you guys have seen this, we have entered into a tip culture. I mean, every time I go to the gas station, every time I go grab a smoothie, somebody's asking me to tip 10, 15, 20%. America and its taxpayers live off of tipped income. This is a huge benefit to them. Being able to deduct the money that you're earning in tips is very, very awesome.
And that includes credit card transactions, right?
It does include credit card transactions as well.
And is there any way for, let's say, Jack to structure his income as a tip?
I feel like a lot of people are like, how do I structure?
Yeah, NetSuite and Oracle, the sponsors of this podcast, if you could just send it to me as a tip, like I could invoice you and then have like a 10, 15, 20%, at the bottom.
Right.
That would actually...
Yeah, I know it has to be voluntary, but who's to say it's not a voluntary? Can I tip myself? Can Jack tip me? Can I tip Jack? How does this work?
I believe a tip comes directly from a consumer that's buying your product or service, and it would be very difficult to tip yourself, and I don't think that's the intention of how the code was written. However, the ability for you to be able to deduct that $25,000, it's based off of you earning revenue, reporting the revenue, and then getting a deduction based off of what you reported. So it's not that you're not reporting the tipped income. It's just that they're giving you a deduction for the tipped income. It's not that it's not taxed. You're still going to pay taxes on it. You just get to take a deduction for the tipped income that you receive. And this also includes overtime pay. So if you're receiving overtime pay, you get to deduct $12,500 of overtime pay if you're single, $25,000 if you're a married filing joint.
So I saw a study on this recently that 8% of hourly workers get overtime, and it was only 4% of salaried workers get overtime. So the vast majority of people, more than 90%, this doesn't apply to them.
That's correct. Yes, it's for salaried workers.
It seems like a big promise or a big headline to be like, yeah, no taxes on overtime. But when you really get down to it, it's like so few people will apply for that. And then of that, it's capped pretty low based on the overtime, and then it also expires in 2028 is my understanding.
Could incentivize more people to work longer hours, though.
Do you think it's actually going to?
I think for a small percentage of people, intuitively, I don't think like a large swath of people will be like, I'll work overtime now because I'm not, I had the deduction. But I do think it will make a small...
But here's the thing, what's the benefit for the employer? Because my understanding is a lot of employers will really like want you to stop working once you get to that overtime pay. Like they'd rather just bring someone else on at that point to take over the hours.
This is the part that I was really looking for. It doesn't really position it well for the employer. It really positions it well for the employee. The employer is still going to have to pay the payroll taxes and still report it. So you're still going to pay the wages and the payroll taxes on the overtime pay. The benefit, though, is that you're retaining key employees because your key employees that are working overtime are also benefiting from the fact that they get to deduct a percentage of their overtime pay, $12,500 if they're single.
Yeah, but they could do that anywhere, like wherever they work if they're going to work overtime.
Yeah.
They might make more just getting a higher paying job, working for their competitor and getting another offer.
But it's another way to build wealth if I'm able to deduct the overtime pay against my federal income because now I'm increasing the amount of money that I get back in the form of a refund.
So is there any way that Jack could pay himself overtime?
There's an income limit, correct?
Yes. If you have over $150,000 adjusted gross income, it starts to phase out. That's correct. You no longer get to deduct overtime pay. But what you could do is position yourself to have a salary and then give yourself a percentage.
There's always something. Right? There's always something.
Give yourself a salary and then work overtime. And if you're clocking in and clocking out, absolutely.
But let's say you're doing that, but then you're getting a distribution from an S corp, then it phases out anyway. Right?
Yeah,
so
that's correct.
Couldn't do it.
That's correct because that counts as income.
Who stands to lose the most from the big beautiful bill?
The low to middle income class. And when I say low to middle income class, I'm talking extremely low income. I'm talking $45,000 and less. They may actually see an increase in how much they pay in taxes. But you have to realize a lot of these people that are extremely low income are relying on various different tax credits like the Earned Income Credit or the American Opportunity Tax Credit, tax credits that were essentially set up for people that are extremely low income. Trump is trying to get the lower income people off of any type of government subsidies or any type of government credits. And so the people that are going to benefit the most are people in the middle class that are right over that 50,000 all the way up to millions. And then the people that are going to benefit the less are people that are making right under 48,000.
So my understanding is a lot of those like social welfare programs were getting cut, like Medicare. There's a lot of money that's being cut out of that.
Yeah.
And that's why it's affecting, although everyone's brackets are going down and the percentages are going down, the people that do rely on those welfare programs, they're going to lose a lot of that funding. So technically speaking, like they're getting helped in this way,
yes,
but hurt disproportionately in this way. So the net is that they're being
But
hurt.
You know what? But that's assuming they don't comply with work requirements and check-ins. That's my understanding, is that with a lot of these cuts, there are requirements of now having to work a certain amount of hours or a certain amount of check-ins that is being applied to receive those benefits. So if they comply with that, their benefits aren't going down. I could be mistaken. I don't know if you know more on this than I do. That's my understanding on it.
It's not a whole lot of details yet coming out to light in the big beautiful bill that I've read on that case, but I would determine that if I'm an employer, I would want to track absolutely everything. Why wouldn't I? I wouldn't want to overpay. So I would want to see more information around that.
The other big one I'm really excited about is the $40,000 SALT cap deduction.
Oh, man.
That's a huge one.
It is.
For a lot of people in high income tax states, California, New Jersey, New York.
Yes.
Saving a lot of money.
Yeah, it is, because most people that live in high tax states, we pay a bunch in property taxes, but we also pay a bunch in state taxes. SALT allows for you to deduct state and local tax. So if you live in a city like New York, you pay a local tax to live in Manhattan, and then you pay a state tax to live in the state of New York. You could pay upwards to 13, almost 14% if you're living in the city of Manhattan and in the state of New York, right? What if you could deduct your property taxes and your state taxes? Well, before this big, beautiful bill, you only used to be able to deduct $10,000. Think about how many people were paying so much in property taxes that weren't able to write that off. Just with this small little increase to 40,000, you have now California taxpayers and New York taxpayers and all alike being able to deduct their property taxes and their state taxes, reducing their overall taxable income.
Phasing out at $500,000 a year.
Phasing out at $500,000 a year.
So you're saying you're taxed state and locally first, and then that amount is deducted from your federal tax.
That's correct. So if you're living in the state of California, you're going to pay into state taxes and file a state tax return.
But it doesn't really help out people living in Nevada.
It does not.
State property
it does on the property
tax.
taxes,
Sure.
because it allow for you to deduct your property taxes. Instead of $10,000, you now get to deduct up to $40,000 in property taxes. So it does help out homeowners.
What are the arguments for and against this? I see some people, and I've mentioned this in my video, really against it, that they say that they shouldn't be subsidizing states like California because it's taking federal income tax away. When California wants to mismanage or spend a lot of money, they get the deductions that doesn't go to the federal level. What are your thoughts on that?
I like it. And the reason I like it is because we saw what it was like as tax professionals prior to Trump coming into office in 2017. I looked at tax returns where I saw California homeowners writing off $100,000 in property taxes and state taxes, $200,000 in property tax and state taxes. In 2017, when the Tax Cuts and Jobs Act got passed, I saw people write in checks for the very first time. I saw people stop taking vacations. I saw people stop investing so much money because their homes were viewed as less of an asset now because it didn't provide as much tax savings anymore. So if you're asking me, how can we really help the nation? I love the idea of being able to increase it a small amount to $40,000. Still allows for people to live in those high income states and benefit some. And in return, for those of us that, still have to pay property taxes, because I know that property taxes suck, even though you pay off your home, you still have to pay property taxes. I want to be able to deduct more of that then.
Now, on the SALT cap, though,
yes,
why aren't more people doing the SALT cap workaround?
What do you mean?
Explain that.
When you say the SALT
cap workaround.
What do you mean by that?
It's where you're able to deduct 100% of the state and local taxes through an LLC or an S corp.
Oh, if it's a business property. You're talking about if it's a business property.
No.
What do you mean?
Not if it's a business property. If if you are self-employed in a
Mhm.
state like California and you're paid through an S corporation, your
Yes.
S corporation can pay your state taxes for you, and that
Oh,
credit,
yeah. You're talking
yeah,
that applies in certain states. That applies in certain states. Not all states apply that. Is that what you're talking about?
Yeah.
The AB 150 law, where I can pay my state taxes up front and get a credit on the state side when I go to
correct.
file my tax
Yeah, I
returns?
thought over 30 states have issued guidance on that, and the IRS has approved those strategies.
I love that. Well,
Yeah.
prior to this year, there's only 11 states that were offering that. So if they increased
I thought it was 30.
No, it was only 11 states that were offering that. I mean, New Jersey was one of them. California was the biggest, obviously.
Yeah.
And it's called the AB 150 law. So just to explain this to everybody,
Yeah.
if I'm an LLC or an S corporation owner, I have a flow through entity, I can choose to pay my state taxes up front this year in 2025 and get a federal tax deduction based off the amount of state taxes that I estimated that I needed to pay.
Yeah.
And then when I go to file my state tax returns come 2026, I'll get a tax credit relative to the amount that I paid in 2025, which I deducted on my federal tax returns. What this does is allows for taxpayers that live in high income tax states to be able to reduce their amount of taxable income because they're paying such high taxes in high tax states, but simultaneously get a credit so they don't have to write a check in when they file their tax returns.
So if someone's making a few $1 million a year through a pass-through entity like that, they could essentially deduct 100% of their California state taxes by doing that.
Yes, they can. Yes, they can. And you need to make sure that if you want to deduct it, that you pay the state taxes in the year in which you claim the AB 150 deduction. The election to claim the AB 150 deduction in the state of California, I believe, is June 15th. If you did not make that election, you missed it.
Why do so few people know about that?
Because most CPAs spend a lot of their time traditionally filing tax returns. And then when they get past tax season, they go on vacations and they come back and then they file extensions and then they enter into tax season again. Most CPAs don't have the time to educate taxpayers on how to leverage the tax code because they're focused on filing tax returns. That's how a traditional firm is set up. If you think about how a CPA makes their money, they want as many clients as they possibly can to file returns for with as little communication as possible so they can get that work product delivered. So if they're taking time away from filing returns to educate taxpayers and to do consulting and to formulate strategies, it shifts their business model entirely.